Welcome, everybody. Thanks for being here today. We are delighted and honored. I will say this because I got to know Jeff, and we've welcomed him back. We've had him a couple of times. Lots of new developments. It's exciting to see the innovation that's going on in what they basically pioneered at Right Side Capital, the micro VC investing, and the results are pretty impressive. And so if you have smart people doing cool things, it's, we welcome that. So Jeff, thanks for being here. As you all know, a little Zoom protocol here. We can't hear or see you, but we encourage and welcome all your questions, and we'll get to as many as we can. We're fortunate to have lots of people attending today, and so thank you all for being here. I just wanted to let you know also for the record that this is being recorded, so I think I'm getting an echo with you there. And so if you care to look at it later or share it with somebody else after, it'll be posted on the YouTube channel for Family Office Insights, and you're more than welcome to share it with others that would benefit from hearing what you hear today. So with that, I'm going to hand it off to Jeff, and here we go. Thank you, Jeff. Welcome. Take it away.
Thanks, Arthur. Good to be back again. And thanks everyone for joining. I'm Jeff Pomeranz, one of the managing directors here at Right Side Capital Management. We're based in San Francisco, and we manage a series of venture funds. We currently have 6 funds we manage. We started the firm in 2010. We launched our first fund in 2012. Today, I'm going to go through the details of our core strategy. But in addition to that, I'm going to talk a little bit about what's evolved in the tech ecosystem in the past decade or so that has actually given rise to the opportunity that we take advantage of. And then obviously the strategy of how we go about doing so, the results and so forth. We are currently launching Fund 5 of our core strategy, and I'll go through all the nuts and bolts on that as well. Let me get the slides up here. Bear with me. Okay.
Actually, so, now it's perfect. Okay.
Okay. Yeah, it's just a slight lag, I think. Okay, so one quick thing before we get started. I'm not going to read through this whole thing on disclosures, but it's getting a lot of attention lately. I will talk about some of the tax rules that we take advantage of that are there to incent really early investors like us, angels, founders. The biggest, most important one is referred to as qualified small business stock. These rules currently are being proposed to get revised. So everything I'm gonna, all the numbers and stuff I'm quoting in here have to do with the way the rules are today. They obviously, like any tax rules, they can change. And again, I'll reference this in a bit more detail later. So as Arthur mentioned, we are focused exclusively on what we refer to as the pre-VC stage for technology startups, largely in the US. We're focused all over North America, mostly the US, in across every geography in the US. Over the past decade, we've now done over 1,200 startups since we launched our first fund, which makes us, one of the most, if not the most active in the space. Now, all of our funds, from a goals perspective, from what our LPs get out of this, what we're trying to accomplish with all of our funds is to produce a 3 to 5x net return, net multiple, do it more predictably and more repeatably, fund over fund, than what people think of as traditional venture. This equates to roughly 20% internal rate of return, sort of a 20% IRR, give or take. We want to do this with mitigating the downside risk. So our funds have very low volatility and very low risk of any kind of capital loss. Again, we'll talk about that a bit later as well. And then we're able to optimize the strategy to take advantage of these tax rules and have extremely low tax liability associated with all of our funds. Now, before I get into the strategy, I want to talk a little bit about what's going on at this pre-VC stage. And so people understand pre-VC, what we mean by that is we used to call ourselves pre-seed, but that's come to mean something definitively not us. It's later than us. So we're earlier than traditional venture capital. We're earlier than what people think of as pre-seed or seed stage. We're earlier than where micro VC funds are engaging. It's typically where companies are looking for very small amounts, several hundred thousands of dollars. And that's important for a number of reasons. But this has all been enabled because of the capital efficiency trend in the tech ecosystem. And capital efficiency meaning, how much does it cost a group of tech engineers to get a first product built, get it launched, get first customer traction and validation? Now, the costs to do that have fallen every year. And this is not a new trend. Tech costs, next year are going to be less than they are this year. That's not new. What is new, though, is that the amounts of capital to get to that first launch have fallen so precipitously over more recent years that it's been extremely disruptive to the tech funding market. And that's really what we're taking advantage of, okay? Because, companies looking for just $100,000 to $500,000, which is today what we're dealing with. When tech companies are looking for that first outside capital, they don't need much money. And that amount is just far below where it makes any sense for the venture capital industry to address. And so there's two real big advantages to addressing this end of the market. Number one, first of all, what first drew us to building the strategy and going after it is simply because the earliest stage has the highest returns as an asset class. Now, it has the highest returns for very good reason, because the risks are higher. Now, the other outcome of this supply and demand imbalance effectively that's been created, of more tech companies than ever looking for these small tranches of capital, but no new body of professional investors has moved in to fill that void of demand. So when you have the supply and demand imbalance, it resulting in just no real competition for us. When we make offers to companies, we don't normally have competing term sheets being offered to those companies, which is the opposite of what's happening at later stages of venture, which has boomed in the past decade. And it's extremely competitive to get into deals at, whether it be a series A round or B round, whatever. So it's completely flipped. So our strategy is targeting exclusively this pre-VC stage of the market, where the round sizes are too small for venture industry to address. We're building a set of processes and strategy as a whole to take advantage of all the inefficiencies that are going on and generate repeatable high returns with very low risk. And again, we're optimizing it for the tax efficiency. So the way we do this is we have built a largely data-driven investment process and strategy. Think of it as a mostly quantitative approach to tech startup investing, where we're using the data on companies, the data on the founding team, the business model they have, and the traction they have to inform us of a better pool of companies. So when we're investing in a company, we're not saying we believe this particular product or idea, is going to beat competition and be the next great thing. We're not saying this particular founding team are the people to get it done, that have the wherewithal to, walk over broken glass to accomplish anything necessary, and the passion and so forth. We know that there's really so much randomness of what becomes the next great thing, what become the big winners, that you can't actually predict those kind of things. But what we are doing is saying, well, if we invest in a certain profile of a founding team, a certain profile of a business model, the capital efficiency there, if we invest in 100 companies with this kind of a profile that we can actually get at such a low valuation, that pool of 100 companies will crush the returns of the market. And we're already dealing with a market that has very, very high natural returns associated with it. So the other part, an advantage we have in having a data-driven process is it's very fast. We can make decisions in days and give answers to the founders, a yes or no within days. That's extremely rewarding to the founders. Even if it's a no, we're giving them a no quickly. We're not dragging through months of diligence to get there. That's obviously a huge benefit to founding teams. And what it also allows us to do, most importantly, is build large portfolios of companies. We can make decisions quickly and build funds with exposure now to many hundreds of tech companies. And when you have now a fund with 500 plus companies in it, at this stage of the market, it has a profound effect on the return profile we're able to deliver back to our investors. And through that diversification, we're protecting the downside effectively and locking in the high returns that are in this space. Now, I'll pause here to touch into the tax efficiency part, because especially more recently, this has gotten a lot of attention. There's a lot of questions on it. I'm only going to scratch the surface here. The most important thing people can take away from this is remember to bring it up with your tax advisor. So there's two tax rules that are really important for us and other early investors like us. The first is IRS Rule 1202, which is referred to as Qualified Small Business Stock, QSBS. Most of our gains should come from QSBS qualified exits, which means that can be tax-free federally, as well as in most states. 45 of 50 states conform to the same rules. And the second rule is 1244. And to go into a little bit more detail here. So again, there's a lot of nuances to this, but the most important aspects of a company that are necessary to allow it to qualify for this QSBS exemption is it has to be a U.S. C corporation. At the time of your investment, it has to have gross assets of less than 50 million, so early in the cycle of the company. And you have to be invested in that company for 5 years or more as equity before the potential qualifying event. But then, if it does qualify, you get up to $10 million of gains, or 10x your capital basis, whichever is greater, free from federal taxes. Now, this rule is currently being proposed to get revised in the big $3.5 billion budget proposal currently being arm wrestled over in Congress. I don't know, if it will get revised, if it's going to get taken out. It'll probably take a couple months for any of this to get worked out. But if it does go through exactly as it's being worded currently in this new budget proposal, it would basically roll back QSBS benefits to the way they were back in 2009, which were a lot more complicated. And unfortunately, it would reduce the benefit. It wouldn't get rid of it. It would reduce it by about half. So it's still a lot better than just paying capital gains, but it wouldn't be as great as it is today.
Jeff,
Yeah.
in the context of this being something that you've structured into the fund with intent, and this is not to disparage other funds, but there aren't a lot of funds that have been so mindful about this, that have the ability to invest at the beginning and have implemented this as part of their strategy to help themselves as investors and the LPs. And so I guess my point is it true, as far as you know, that not many funds like you are doing this sort of tax thoughtfulness?
I think, so it's a good point. I think more and more are, because it's getting more attention. And early stage venture funds, if you're a seed stage venture fund, you're going to be able to take advantage of these rules as well. I don't think as many that can take advantage of it have been tracking it and doing so, though, which is remarkable to me. But I will say they can. Where it tends to tail off a little bit is they can't get as much out of it, because even early stage venture funds that do invest in a seed or A round, that first check they're writing will be early enough to qualify, certainly. But as they add, when they follow on invest into the B round, the C round, that stage probably won't qualify. And remember, they have to hold on to it for 5+ years. So those funds typically just can't take advantage of it to the extent that angel investors and investors like us can.
Largely because they're early enough that they can take advantage of the 5 years.
Yeah, it's the 5 years, and because at a fund level, most of the capital of venture funds is still, even early stage venture funds are actually invested. They might write a check early, they might write a $250,000 or $500,000 check or $1 million check early enough, but then they're writing $5 million or $10 million checks in later rounds, and that's usually going to be too late. So from a percentage perspective of allocation, the bulk of the fund is really invested at later stages for most of the venture industry, not all. That helps.
That's helpful.
Yep. So the other rule here that, and again, I'm just going to mention it, is 1244. It's not quite as exciting as dealing with not paying taxes on gains. It's how losses are treated. This rule for qualifying events, and it has to be actually invested very early in the cycle of a company when they're less than $1 million raised, and which again, most of our, almost everything we do fits. But if it qualifies, it allows losses. So if that company fails and we take a 0 on our $100,000 investment, let's say, those losses get passed through on the K1, not just as a capital loss, but they can be taken as an ordinary loss. So you can use it against W-2 income or whatever. So it's just, those losses can be used for greater benefit, is the point. In aggregate, when you combine all of this stuff of how the losses all get passed through, plus how most of the gains are going to be qualifying events, the net effect of it is actually very, very little tax as a whole that our LPs are paying. So let me segue into performance. So our first fund, I'm going to go through just our first fund in a little detail first, then I'll go through all of our funds in brief. But our first fund we launched in the beginning of 2012. We invested over a 3-year period into 279 companies. All of the capital with this strategy is deployed essentially in single one-time checks. We're not doing follow-on investing in the strategy. We're generally investing as little as $20,000 up to $200,000 or so. And so through Q2, that fund is now at over 6x net multiple. That's a 26% IRR. And we've distributed 176% of investors paid in capital. Now, through Q3, actually, that'll be jumping quite a bit. We are in essentially the harvest phase of our fund. We're 9 years in, a little over. We're going to be looking to wind the fund down in the next 12 to 18 months. So we're sellers of assets here. So we've had a number of large liquidity events this past quarter. So actually, we're going to jump to over 7x net multiple and about 5x distributed now. So obviously, Fund 1 has far exceeded our stated goals. It's done tremendously well, obviously. Now, an additional note on the tax effect here. Now, because 2021 is not complete yet, the numbers here are through 2020 tax year. They're numbers taken from the K1s over 9 years. So for a $1 million investor into our Fund 1, they would have paid in $930,000 because we did have a little bit of liquidity in year 3 of this fund. We've distributed just under 1.5 million. Most of that, as you can see here, almost 1.2 million of the 1.5 were QSBS qualified gains, so no federal tax. Then when you combine all the rest of the losses and other stuff in there, the net effect from a tax perspective to our Fund 1 investors through 2020 is actually a negative tax impact. They've actually gotten in $95,000 of refunds or tax credit, however you want to think of it, pushed through the K1s. So it's been actually a negative tax liability. Now, this chart is now our first 3 funds, Funds 1, 2, and 3, and it's showing the net multiple, or TVPI, total value to paid in capital, of each of our funds, basically tracked quarterly on this chart. So the blue line is Fund 1. You can see it's now a little over 9 years in. The orangish line is Fund 2, which was launched in 2015, is a little over 6 years in. And Fund 3 was launched in 2017 and is a little over 4 years in. A couple things to note here is just that you can start to see visually now how the funds don't have much in the way of ups and downs. They're all following the same kind of trend line. And you can start to see that Funds 2 and 3 are obviously ahead of where Fund 1 was at their respective periods of time. Now, the reason why I'm pointing this out is because there's a couple of good reasons for that. It's not just an anomaly. Yes, we are obviously better at what we do, like you would expect any good manager over 10 years to, get better, right? But in addition to that, this capital efficiency trend, since we launched our first fund, has continued to just get more and more extreme. What that has allowed us to do is to invest in companies that are further into their life cycle. Because remember, capital efficiency means tech companies can do more with less capital more quickly, so they can get a product launched more quickly, et cetera. So by the time they're looking for first outside capital from investors like us, in Fund 1, we were largely, back in 2012 and 13, we were largely investing in pre-revenue companies. They still needed a chunk of capital and maybe a year of time on average to get that first product built and launched. Now, we invested, and Fund 1 was invested into all of its companies at an average valuation of roughly $2.5 million. That's what the value we're investing in them at the time we invest. Now, we're still in Funds 2 and 3, we're actually still investing at the same average valuation. The difference is, at the time they're looking for that first outside capital, by the time we got to Fund 3, they're no longer pre-revenue companies because they can bootstrap themselves often to actually getting that first product launched. And when they're looking for first capital, they have revenue now. So from a pool of companies perspective, of course, Fund 2 and Fund 3 would be doing better because we're taking less risk for the same price is a way to look at it. We no longer have as many failures of companies in the first year or two because they run out of money before they even get a product built, or they launch a product that no one cares about, things like that. So that trickles down to performance at the end of the day, which is really the driving reason why funds 2 and 3 are tracking better so far. Now, most recently, the stuff we're doing today is even better, because not just do we have these same trends we're taking advantage of capital efficiency, but we've now had this disrupted economy and ecosystem. And it doesn't matter what the disruption is. In this case, it was a health pandemic, but shaking things up is always good for venture as a whole, not just us, but any venture. When you're earlier, when you're early company like this, you can adapt more quickly, you can pivot more quickly, you can change your cash burn more quickly than competitors, and it creates opportunity. So from a macro perspective, it's actually the best environment we've ever had for making new investments, like it is, again, like it is for any early stage investors. One thing to point out just on some of our exits is, because we're invested so early and have this added effect of focusing on capital efficient companies, meaning some of them have a lot less dilution, we can get extremely high multiples on our exits, 80, 100, 200x multiples. The most recent exits we had just this past quarter, we had 400x multiples. So we're getting these kind of multiples on exits where traditional venture might be getting only 10, 20, 30x multiples, which is still great, don't get me wrong, but we can get extremely big multiples on our exits because of how early we're in.
Jeff?
Yep.
Is the logic that if you exit before 5 years because the company exits, right, they sell out or something, does that impair the tax benefit?
Yeah, so if the company, let's say, gets acquired 4.5 years after we invested, yes, that will not qualify for the QSBS exemption. So we're paying tax. Now, it's a good problem to have, having a big exit really early,
because you have a lot of money to pay the tax, right?
But you do pay the tax.
Yeah.
Yeah. A quick note on the three of us. So the three of us are partners in Rightside Capital. We've been working together since the beginning, so 11 years now or so. I come from the financial services side of the business. Prior to Rightside Capital, I had 20 years, having started at Smith Barney on the wealth management side of the business. Then I started a brokerage firm with partners that we built as a tech research boutique. Had some small banking business alongside that as well here in San Francisco. My two partners, Dave and Kevin, are both tech entrepreneurs from the Bay Area here. They went to Stanford undergrad together and had separate careers, doing multiple startups each, multiple exits, all in the area here.
So we have a quick question,
Yep.
if you don't mind. Can you roll over your QSBS investment into a new venture to preserve the tax benefit like you can with a 1031 exchange or something like that?
Yeah, there are some rules that allow you to roll that into new investment dollars. Effectively, though, for fund investors like us, it's a moot point because we don't recycle capital in the fund. So if there's an exit 5 years in, we're not taking that money and investing it in new companies. Theoretically, you could, if we had an evergreen strategy, you could do that. The other problem is, well, if you take that money and put it into new startups, yes, you might be able to have some potential added tax benefit, but you're also taking all that risk again from ground zero. So but again, there's additional nuances there, and I want to make very clear, this is not comprehensive tax advice. We're not acting as tax advisors. It is something you can look at, though, to your question. But it's not something we do in our funds.
Right. Just to further the point is, check out with your own accountants before you do anything,
Yes,
just for the record.
correct. Yeah. So what we do is we track everything on all of the companies, on all of the QSBS that might be qualifying. We're delivering through the K1 to every LP everything they need to give to their tax people. But we're obviously not providing the tax advice. Okay, so I want to have one quick sidebar here. I'm not going to go in much detail, but I did at least want to reference, I've mentioned it once or twice. We do have two distinct strategies and two lines of funds within the firm. What I've been talking about is what we refer to as our core strategy, which we're launching Fund 5 with right now. We've been doing for 10 years. We do have a second strategy, which goes under the branding of Peregrine Select. We have two funds now, and we are now still accepting investors into Peregrine Select Fund 2. In real brief, what we're doing in Select that is different is we're actually capitalizing on this huge body of portfolio companies that we are tracking and managing within our existing portfolios. That's effectively proprietary data and inside information, effectively, like being private, we can actually do whatever we want with that. So we're cherry picking out extraordinary opportunities from our existing portfolios of companies, usually 1 to 3 years further into the life cycle of the company when they have more validation, more traction, more revenue. And we're also taking advantage of another sort of crack in the whole VC ecosystem that we've identified as a segment of founding teams that aren't able to really get what they want from the venture capital industry. The venture product that's delivered to startups is generally pretty homogenous. It's not wrong, it's good and right for most companies, but it generally is gearing funding rounds, for instance, to be 20-25% of the cap table, regardless of what stage they're at and how much money they need. It often is, usually geared towards companies wanting to be, pushing them to be on a high cash burn trajectory, shooting for huge exits. And a lot of founders, sometimes they want to, God forbid, get cash flow positive, or they want to look at potentially a earlier exit in $100-200 million range. That could be a life-changing event for the founders. Anyway, there's a segment of the founders where they're not able to get that from the venture industry. We go into it and we approach them from a sense of we can be flexible. We can offer them what they want. And when you give customers what they want, but they can't get somewhere else, they pay more for it. And that effectively for us means we get these opportunities at significantly discounted valuations. And then we build a more concentrated portfolio of 25 companies or so, give or take, of $250 to $1.5 million, $2 million checks into each of these companies. So that's the Peregrine Select strategy in super brief. Obviously, anybody that's interested in learning more about anything we're doing, whether just to touch base on what we're doing on the investing in out of our core strategy, Peregrine strategy, whatever, feel free to reach out. I'll make sure I give you the my contact information at the end here.
You're probably going to get to this, but
yep.
In this particular fund, how much do you think you'll be raising?
Got it. So this Fund 5, we are actually doing, we are capping the capacity at 30 million. We are launching it right now, and we're going to also be having a final close on the fund no later than February. So it's going to be a fairly short fundraise and a capped capacity. So there will be some challenges getting everyone in. So the reason why we're doing this is because it's being we're investing this particular fund over a bit of a shorter investment period, and that investment period is overlapping with our Fund 4, which we're still investing out of right now. The short version is we had additional capacity, and we wanted to raise another fund to take advantage of that capacity for deploying capital. But because we're aligning it with Fund 4's investment period as well, we're going to be deploying all of Fund 5 in probably 2 years or so. That's pretty short time frame. So it caps the capacity around that 30 million zone. A couple other just nuts and bolts items on structurally the fund and how it works. Fund 5 is, like all of our funds and most venture funds, they're structured as 10-year vehicles with 2 one-year extensions. It is a 2% average management fee per year over the life of the fund. There's a 20% performance fee or carried interest. We do not take our carried interest until investors are paid back their invested capital plus a 5% cumulative preferred hurdle rate. So lastly here, there it is. So here's the contact information. If anybody's interested, obviously reach out. We either through Family Office Insights or myself, you'll get an email. I think, Arthur, don't you send everyone a copy of the recording and stuff like that? I know a lot of people sometimes can't make it, but
Yep.
even though they're registered, stuff
And
like
we'll
that.
also send you the list of everybody who registered.
Yeah.
And you can bounce out an email so they have your contact information independently.
Good.
Can we go back to the slide where you have Fund 1, 2, and 3 with the chart?
Yeah.
It's always, there's a view of venture that, throw a lot of money at a company and hope that, you get 2 unicorns and you flush the rest. And I'm being snarky on purpose. For example, in Fund 1, what percentage, you don't have to be precise,
Yeah.
went to zero?
Yeah, so currently it's roughly, as of today, roughly 40% of the companies today have failed with a complete zero return. So you're talking about 110, 120 companies out of the 279.
Yeah.
Now, what's important with venture capital is for, we're applying, we're attacking the venture capital math of how it all works, right? We're applying data and math to extract the returns that are inherent at this stage of the market. So the asset class is really high returns, but venture capital has really skewed return curve, meaning it's a very small percentage of the winners produce such high returns that it's producing the vast majority of all the liquidity that you're depending on. So while we might have 40% of zeros now, and it might, by the time we wind it down, it might be 60% or zeros. That's not as important as making sure you have to have some type of strategy to make sure you're capturing at least your fair share of that winning 5%. Okay. And everything we do about how we are identifying certain profiles of companies that are better, the whole idea here is that we're skewing the odds in our favor, that we're going to get more than our fair share. We're going to target companies that have greater survivability, greater operational capabilities. We know we can't predict which products are going to be the big winners. We might have opinions, but that doesn't mean that that's better than the founders' opinions. And but we're going to skew the odds in our favor. So it's about getting a higher percentage of that top percentiles, which obviously in Fund 1 we've been able to do because we're vastly outperforming the venture industry as a whole.
Yeah, on the other extreme, Fund 3, do you happen to know offhand how many you've had to flush this early on? What percentage? About?
Yeah, I don't remember actually off the top of my head, but not that many, because remember, we're investing the capital over roughly a 3-year period of time. Yeah. We're only at 4 years in. So there aren't, I forget if it's 10 or 15% have been zero so far, but obviously not that much, because some of the investments were made only 18 months ago. So it's pretty fresh and early at this stage of the fund.
So are you doing a drawdown structure?
Yes, it's a capital call
Yeah.
structure. Fund 5, for in a new investor coming into our Fund 5, let's say in November, they're gonna we're gonna call 50% of their commitments, their what they want to invest in the fund, and the balance will be called over the following roughly 18 months.
Yeah. So you're just not sitting on cash, not using it. I get it.
Correct. We're investing it over multiple years. We don't need the money all up front. Better to let every individual earn something on their money before they need to send it to us.
Yep. This leads into a question that's being asked, but if I remember correctly, Jeff, you have on the website, the application. People can go in and send you their company, and that's how you make it easy for deal flow to arrive to you. So the question is how are you faring in this very competitive deal flow market where valuations are going out of control and certain funds are winning all the deals because they're overpaying? That's my narrative, but
yeah. So you're right. All of that is going on. It's intensely competitive in venture capital right now. Venture capital has raised hordes of money over the past bunch of years. However, all of that activity, what you and I are talking about, is later than us. It's the opposite. At the stage we invest, again, which is how we're defining pre-VC stage, it's the opposite. There's not much in the way of professional competition. There isn't that much on an absolute basis, that much capital really getting deployed there. It's still friends and family, some angels, individuals, stuff like that. But there aren't large bodies of professional investors, venture capital firms deploying capital there because it's just too small an amount for them to bother dealing with.
yeah, that makes very good point.
So
Yeah.
that's why it's this wacky kind of, until people understand that supply and demand imbalance, it doesn't make any sense that we are actually investing at a lower valuation today than what we did in Fund 1. And it's the opposite if you're a Series A round early stage venture investor. All of those valuations have done nothing but go up in the past bunch of years, every year, because it's the opposite. There's actually more money chasing every deal, not the other way around.
Yeah. If someone, before the webinar went live, guys, we were talking a little bit, Jeff and I, and about the impact on QSBS of whatever might happen in Congress and the bill and so forth. And there's a lobby, of course, for the venture community. Is there somewhere you could send somebody to have like a website or to the lobby where they could have an impact and voice?
Yeah, actually, good question. So the Angel Capital Association.
It wasn't my question. It was from the audience. So thank you for the question.
Yeah. So there's actually the Angel Capital Association, ACA, put out something recently, and again, I can forward it to anyone that's interested. They actually are encouraging everybody to reach out to their congressmen and women, senators, et cetera, to and they actually have templates pre-made so you can lobby on behalf of this industry, because essentially while it's illogical to change this rule, that doesn't mean it won't happen, because it
happens all the time.
But the rules were there to incent high risk early investing, get money into new companies for job growth and job creation, and it works. I mean, it's been tracked. It works, creates jobs. So while it sounds ludicrous at a time like now to roll back a rule that's there to create jobs at a time when really what they want to do is they have to figure out where to get more taxes from. It doesn't mean it won't happen, but personally, I'm going to be surprised if it really does go through the way they are anticipating. And it's not that big of a bucket of money to go after anyway. So again, doesn't mean it won't happen, but I'm still going to be a little bit surprised if it goes through the way they're proposing.
As usual with the stuff that happens in DC, there's always 3 layers deep of some agenda bargaining chips, let's just
Yeah.
call it House of Cards, which everybody should watch. Should's a bad word. Everybody would enjoy watching. We have another question about if you were a U.S. investor, you can take advantage of this QSBS. But if you're a UK investor, that's clearly no. But you could, as a fund, invest in a UK company, right?
Yep.
Does that happen?
We do have non-US companies. It's a very small percentage. We're not seeking them, but they have C corporations here in the US they've established.
Right.
Their teams might be from France or Ukraine or whatever, but and it's only a small, less than 5% of our companies are like that, because we come across them because they came to New York to participate in an accelerator, and we came across them there. So for the tax part of it, though, they do need to be a US C Corp, number one. So if it's a non-US company, and there's some small percentage, we have invested in a number of Canadian companies, those don't qualify. And if you're a non-US taxpayer, you can't, then this doesn't matter. And again, listen, this strategy is not built to take advantage of tax rules. It just happens that everything we're doing gets this nice benefit.
And why wouldn't you? Yeah.
So, I want to stress that we have plenty of non-US tax-paying investors in our funds from all over the world. It's still it's still just as great a strategy. It just they don't get the tax benefits.
Yeah. So just for fun, it must be a friend of yours, Bradley Rotter, says, "Nice job, Pomeranz." So
yeah. Hi, Brad. Good. Yeah. Glad you could join.
Yeah. Great. So this has been super helpful. I've always, you guys are so smart, and I don't need to make you feel good. You just are. So I want to thank you for doing this again. And we're going to do more about Right Side Capital in the future. So, just stand by, everybody, and take note that we're going to be inviting Jeff back again. And as I said, we will be connecting him with all of you, and you will be able to have a direct connection. And then I imagine that if you'd welcome, Jeff, if there's anybody out there that have funds or companies that are at the stage that you look at, you're welcome to go to the website and go ahead and apply. Yeah,
absolutely. We're always happy to receive any companies that might be relevant for us. Always happy to look.
Yeah. So you have a final comment, and then we'll wrap it up.
Yeah. Well, thanks again, Arthur, for bringing me back. And thanks everyone for joining. Look forward to chatting with many of you in the future. Thanks a lot, everybody.
Thank you, Jeff. And once again, excellent. And by the way, we have some questions that we didn't get the answers, but we're going to send them over to Jeff as well. And thank you all for being here and supporting Family Office Insights as you have for such a long period of time, and taking the thing that you can't make more of, and that's your time. Till next time. Thank you.
Thanks a lot, guys. Bye-bye.